for 2023 and 2024, when the Fed stopped raising rates, every dip has been bought. So we know the stock market, the S&P 500 benchmark, has returned over 50% in 2 years. That's not normal, okay? The average is about 10%. All right. So when the stock market is doing those kind of returns, that means, people ask me, why do stocks go up? Why do stocks go down? I just try to keep it simple, stupid method. I'll just look at it as supply and demand. Potatoes and tomatoes. Seriously, I mean, I'm being facetious. Obviously, you have a lot more work that goes into it, but I just tell them more buyers than sellers. When there's more buyers than sellers, stocks go up. When there's more sellers than buyers, stocks go down. Period. That's the simplest way of putting it. So when I say that, people go like, "Come on, it's not that simple." I'm like, "Yeah, it is that simple." Because on a daily basis, if you look at it, if there's more buyers and sellers, more demand on something, price will go up. It's just like anything else, like eggs today. There's more demand and not enough supply, and price goes up. Price has to get adjusted. But retail traders, and there's also this $7 trillion sitting in money markets, right? And they certainly have been putting that into work over the last couple of years, and every dip has been bought. Is it time for every dip still to get bought? It seems like it, because there is clear indication that on last Wednesday, the CPI dip was bought, and that CPI opening was a nasty opening, right? And the opening tick was the low, and people just showed up with their dollars and they bought the heck out of it. And sure enough, we're approaching all-time highs on NASDAQ and the S&P 500. But so the appetite for risk is not only through stocks, but through ETFs. Obviously, people are passive investing, and they're going right, dollar cost averaging into S&P 500 index or triple Qs, whatever they're doing. And passive investing is very prominent these days. It was nowhere to be found 15 years ago. Today is a lot of people do that. But besides that, the market has created more tools called leveraged ETFs. Okay, not only people are buying into the ETFs such as SPY, triple Q, IWM, all these, VOO by Vanguard, by BlackRock, all these ETFs. There's trillions in these ETFs now, and every pullback, people stepped up with their money. But now what they're doing is they're getting more aggressive. They're buying these leveraged ETFs that Wall Street has created, right? There is 2x ETFs, 3x ETFs, and you're getting more bang for your buck. But if you're wrong, you're going to be horribly wrong in these things. So I highly recommend, if you don't know anything about leveraged ETFs, because you think you're going to make money, don't go jump into these things, because there is slippage in these things, right? They're not to be bought and held. It's for daily return purposes only. But the appetite for risk is through the roof. Leveraged long equity ETF assets reached a record $95 billion last week, just in a single week, right? By comparison, during the 2021 stock market mania, leveraged long ETF assets were $67.6 billion. Since Q3 2022, total assets in funds using derivatives to make long bets have tripled. At the same time, leveraged short equity ETF, obviously we have leveraged short and leveraged long, ETF assets have declined by 13 billion to 8.5 billion. So, in other words, for $1 in leveraged short ETFs, there are record 11 in leveraged long ETFs. So all these need to get unwound at some point if there's a sell-off, right? So this will add fuel to the fire. So bullish sentiment is alive and well. It's pretty obvious. And to me, retail is in. So when everybody and their uncle has invested in the market already, and let's say there's 100 people in the room and 98 have invested, unless the remaining 2 are Warren Buffett types with 350 billion in cash sitting, right? You got to take the contrary opinion, contrary the other side. I mean, that's the way people make money in this market. So when everybody's in the boat, when everybody's in the pool, who else is going to jump in the pool? Unless it's a massive whale, I don't know. Is this going to continue? Is every dip going to be bought in 2025? At the moment, so far, in just a month and a couple of weeks that we've been in 2025, yes, that's what's happening. And people are putting money to work on every single pullback because it has worked in the past. But how many of these people have experienced a bear market, a cyclical bear market, and because the average bear market lasts 18 years, luckily, not longer than that, but it's brutal, right? The drawdowns are 40, 50, 60%. Look at history. You got to learn from history. Again, I am not saying this is going to happen. I'm just putting a warning signs out there, that all the warning signs are out there, that retail is in the market full bore, right? They're all in the pool. And the rug pull is near, maybe, but I'm just saying that if you're a retail investor, which most of you are, be careful with just buying every single dip, because there will be a day that the music will end, and last one out the door is going to get hurt. So my concern is for the short term, for about 6 months to 8 months ahead. Longer term, DCAing works, dollar cost averaging works. And if you're happy, you should be happy with a 10-11% return with the dividends reinvested on the spiders, on triple Qs. It works. Yes, there are down years, but in general, markets have a tendency of going higher over long periods of time. For traders like me, who pay attention to more short-term signals, I think we're getting a little frothy up here. And but is that going to stop me from buying things and selling things? Of course not. However, I'm going to be really, really careful this year, navigating and trying to hit more singles like I did in January, as opposed to going for doubles and home runs, right? Are there stocks that are going into nosebleed levels and fundamentally they're not worth what they are? Of course they are, but that doesn't mean anything, because the market's always right. The price that you see on your screen is the price. That's the scoreboard. You cannot argue with that. You cannot have personal biases or other biases, then otherwise you're going to go to the poorhouse trying to short all of these stocks, right? So to me, the important thing is making sure that when you do go invest, do it slowly. Dollar cost averaging works wonders. It has worked wonders. So dollar cost averaging, if you're returning 10% a year, and according to the rule of 72, take 72 divided by 10, every 7 years, you're doubling your money. I mean, in what world are you going to get that, right? So dollar cost averaging works. And the important thing is, everybody's doing it. When there's a dip, they're stepping by, and buying the market with both hands, and it's working for them so far. But I feel like there's going to be a rug pull this year at some point this year. Is the market going to go up another 25% this year? I don't think so. My prediction was about 6%. And to finish 2025, we'll probably make new highs, few more, and then end the year somewhere around 6 to 8% higher in the indexes. But we'll see how wrong my prediction is going to be.